So we're going to talk about Chapter 5, which are financial services. A lot of you may be going into the financial services field, which typically involves banking. Um, so it's pretty straightforward because most of you have already been through a lot of these kind of experiences, meaning setting up a checking account, getting maybe a debit or credit card, and so on. There's your learning objectives. You can read at the top. Um, so this slide is simply saying that it's not on your outline. It's just talking about the fact that in recent years, banking has moved from the traditional brick and mortar place to your smartphone. A lot of you may be even using fintech firms, financial technology firms, not even traditional banks to deal with your finances. So when we talk about managing our daily money needs, that's going to be just what it means. Daily needs, buying groceries, paying rent, and so on. Okay, this is what we call our cash management plan. When you need more cash than you have available, you either have to liquidate. So liquidate simply means converting something that might be like a CD or something, or that's in your savings account, and then or you have to borrow money to be able to pay off whatever it is you need. Your savings or borrowing reduces your net worth. So remember, your net worth is assets minus debt equals equity. And equity is the same as net worth, right? So some mistakes that are made is that with all of us is of course overspending from impulse buying. And using credit. So there's studies that show that we tend to spend 12 to 18% more when we use credit cards as opposed to cash. Now we're going to almost a cashless society. I imagine a lot of you don't even carry any cash. I seldom have cash on me because everything can be paid with your phone or your, of course, credit card. And not having enough liquid assets to pay your bills. So remember, we're talking about mistakes frequently made. So if you don't have enough money to pay your bills, of course, you're going to go in debt, or you miss a payment, and then you're going to get penalties and so on. So when we use savings or borrowing, this is one thing you really got to monitor to make sure that you're not doing that to pay current living expenses. It's okay if you're doing it to maybe buy a house or buy a car, but when you're doing it to just pay expenses, and then you're creating a debt by buying something that's expendable, that's disappearing, and that's really not a very good use of debt. And then failing to put unneeded funds into an interest-bearing savings. So if you just have all your money in a checking account, not getting any interest, then that's not the best use of your funds. And keep in mind that interest right now is really pretty low, so it's not as critical as it once was. So types of financial services, savings, cash, and so on. So the biggest one here are CDs, which stands for Certificates of Deposit. And that's probably one of the most common ways that we save money. And it just means that you're putting your money into the bank, typically a bank. You can buy them from other institutions, but typically it's a bank. And you put it in there for a certain amount of time. It could be, I think, as low as a month up to like 5 years. And typically the longer you have it in there, the higher interest that you get. These are just talking about the various types of financial services that are out there, insurance, real estate purchases, or whatever. Not a whole lot there. This is an important term, trust. So it's a legal agreement that allows one party, provides for the management and control of assets by one party for the benefit of another. So some of your parents may even have a trust set up for you in case something were to happen to them. They might say, well, until you're 18, and I know you're all 18, but until you're 18, maybe somebody else is going to watch over it until you do become an adult. Okay? And it's usually created by a lawyer. And so there's kind of an example of how a trust might be used. An asset management account. So a lot of you that are going to be going into the financial services field are going to be doing what we call asset management, or wealth management is kind of probably more typical term nowadays. And this would be like, for example, Fidelity, Merrill Lynch, a lot of kind of brokerage houses are also called like wealth management firms, and that they manage the wealth for their clients, and they typically charge a fee. The going rate right now is around 1% of the assets that your client would invest with you, and they provide kind of a complete financial service for just that 1%. So as I mentioned a little bit ago, there's a lot of fintech firms, there's a lot of banks that have their own apps, and and that's fine. And there are some banks that are totally online. You can't even go visit them. And you know, I don't, I haven't used any of those, but a lot of times, oh, I take that back. That's pretty bad. I I do think I have a bank that's called Aspire, and I don't think they have any physical um, locations. And the reason I set that up, sorry, I forgot about this, is that I can use their ATM card at any ATM across the world. So it was great when I used to take students on GCP, and I wouldn't have to pay any ATM transaction fees, which can get expensive when you go overseas. Um, so a lot of times they have better deals because they don't have the cost of all the real estate. The downside is you can't like go physically talk to them, see them, and when it's your money, that is important. So I primarily deal with my local bank, which has a lot of benefits. Um, so debit cards, some of you may have debit cards, and this is simply stating that it uses your own funds as opposed to a credit card, which is using the funds from, you know, MasterCard or whoever you have the credit card with. Some of you may have prepaid debit cards. You know, I don't really want to talk much about this, but benefits include lowering your debt by helping to control your spending and buying on credit. So, you know, you get a prepaid card and it has $100 on it. You say, okay, that's all I'm going to use, whatever. So remember this term opportunity cost. So what's the opportunity cost? Well, of putting your money in one place versus another. So for example, typically the longer you put something into an account, meaning that if you bought a 5-year CD, you are going to get a higher return. Okay? The cost is that you have low liquidity. So if you wanted that money right away, you couldn't get it until it matured at 5 years. Now, you can get it, but you just have to pay like a withdrawal penalty. So the point is, that is what we would call an opportunity cost. You get a higher return, but you can't have as much liquidity with it. Okay? So for example, when they talk, a bank says, okay, there's no fee checking account, but you have to keep a minimum balance of 500 in there. And that's so they've got the money, they can make interest on it, and they don't have to pay you anything. So it's a trade-off. You could have a fee checking account, but you don't have to have any money in there, or a no fee and you don't get any interest. Okay? Once again, interest rates are about the lowest, like the lowest in your lifetime and probably about the lowest in my lifetime. So interest doesn't come into account too much right now when it comes to checking and savings accounts. So that's why you really need to pay attention to kind of what's going on in the interest rate world. And of course, if you're in the financial world, career-wise, you should definitely be aware of all of this. And of course, how can you get aware of this? Well, everything I have here in red. Now, I didn't put this on your outline, but I want to encourage you, especially even as you're going to get a job, is to be reading the Wall Street Journal or one of these periodicals, or it could even be like, you know, even just watching CNBC for a while. To be able to talk about what's going on in the financial world when you get into that interview, so the employer realizes, hey, you're motivated to know what's going on, you're taking the initiative to do it, and therefore, you know, just a little bit cut above everybody else that doesn't really know what's going on. So imagine you go into an interview and for a bank, and they say, so what do you think about interest rates right now? How are you going to answer that? Well, by reading all these periodicals, you can know what the trend has been, what the Fed has been talking about doing, and so on. So these two arrows, which are there on your sheet, are just talking about kind of strategies that people can use when they know kind of which way interest rates are going. Now, it's always hard to know which way interest rates are going. If you asked me a year ago which way interest rates were going, I would have said definitely up because they were the lowest they've been for years and years and years. But then COVID hit and everything changed and they dropped to like nothing. But a lot of times you can kind of get a sense of where interest rates are going. So for example, this says use long-term loans to take advantage of current low rates. So if you're buying a house and you know interest rates are extremely low and you really believe, and everybody, economists are saying, interest rates are only going to go up from here, then you would want to lock in that low rate. You don't want to get an adjustable rate because interest rates are going to keep going up. So lock it in for long term. On the other side, select short-term savings instruments. So you don't want to buy a 5-year CD if interest rates are going up. Maybe get a 6-month CD, and hopefully interest rates will go up after 6 months, and then maybe start locking in a little bit. Okay, and then this is basically kind of the opposite. So here's this shows you, and it's there on your page, kind of the trend of interest rates. And as I said here, you can see the prime rate used for companies loans went down quite a bit. 2018, things were starting to really pick back up again, and now they've gone back down. We're like 3.25. The discount rate is 2.25. So you can see, look, back in the 90s, almost 7%. Back in 2000, 5%. Huge difference. And you can look up these other ones. Mortgage rate. Look, in 1990, 10% to borrow money for your house. Now, about 2 3/4, about 2.75 for like a 30-year mortgage. So that's why the housing market during COVID has taken off, because interest rates have become so much lower. So look at the difference, 10 versus 2. You could buy so much more of a house now than you could, 10, 20, 30 years ago. Or even, look, this is 8% back in 2000 when you guys were being born. 3 times as much almost. So it's become a lot less expensive to buy a house, so people are buying bigger houses. Maybe shouldn't, but they are, because they can afford more. So now I want to just talk about all the different kind of financial institutions, and many of you may get jobs in some of these institutions. So you are aware of probably most of these commercial banks, which offer almost everything, especially the larger ones. Savings and loans are becoming fewer and fewer every day. They're getting taken over by the commercial banks, and basically they're about the same as commercial banks. They used to be more for just doing kind of like home loans, mortgages, and things like that. Now they pretty much become just like everybody else. Same with the mutual savings bank. These are typically smaller banks and communities, and they're owned by the depositors. And those are getting bought up all the time because the regulations have come up so much, and it makes it really hard for them to survive just by, if they're small. Credit unions are doing very well, and these are, the reason why they do well is because they're a nonprofit. If you therefore are a member of a credit union, you get access to cheaper money, meaning lower rates on your cars and your houses and so on, and you maybe get a little bit more in your savings. So banks really don't like credit unions because they have an unfair advantage. So banks are always lobbying politicians to say, hey, look, they don't have to pay taxes, and therefore they are getting benefits that we don't have. And so you can see here they have lower fees, lower loan rates, which I just mentioned. So if you can find a credit union that you are able to join, and used to be that you had to be like a member, for example, in Athens, I think you had to be somehow affiliated with OU, either a student or employee. But I think they just recently might have changed that to like you live in the community or something like that. So anyway, check to find a credit union near you, and you can find a lot of times a little bit better deals. So I've had a lot of loans through the OU credit union. There are even life insurance companies that provide, some of these different kind of services. So they can offer savings, and of course they provide financial security for dependents. That's what we'll talk about, a whole chapter on life insurance later on, but it just means that if you have somebody depending on you, buy life insurance for them. Investment companies, also referred to as mutual funds, they can offer a money market fund. So a term all of you should be aware of. Money market funds are a type of mutual fund. Once again, we'll talk about mutual funds more in depth near the end of the semester. But it's where you put your money in, and this company will then be buying like treasury bonds, treasury bills, and things like that, CDs. And you can even write checks out of it. But these accounts are not covered by FDIC or Federal Deposit Insurance like banks are. Brokerage firms, finance company, credit card companies, these are all various financial institutions that can deal with, cash management, if you will, and even mortgage companies. So you may not have heard of mortgage companies, but, I don't know if I mentioned, but I'm on the board of a bank, and, and that primarily lends to people buying homes. So we don't do commercial lending, we do mostly mortgages. And we notice that, why is it that people, so we may have the lowest rate, but we don't get all the business, or we might even have a higher rate and we do get the business. And so I did a lot of research on this and found that most people, when they're shopping for home loans, which is like the biggest purchase they'll ever make, take very little time researching where they should get the money. Where you should get the money is where you're going to find pretty much the lowest interest rate. There's some servicing issues, but pretty much once you borrow the money, all you got to do is you're sending the check every month. You don't care who it goes to. You shouldn't really care. It's you want to lower your payment. So check interest rates. It's like one of the top pieces of advice I want to give you. And I know most of you are not going to buy a house for another 5 or 10 years, if at all. But there are companies in your town called mortgage companies. This is all they do is mortgages. They don't have checking accounts and things like that. But a lot of times they're less expensive than even credit unions or your bank. So I've used a mortgage company here in Athens before, and it saved me, hundreds of dollars over the years. So a lot of people say, well, I'll just go to my bank because I know those people. Well, if you're looking to buy, I don't know, anything, a car, you don't just say, well, I'm going to go next door because Bob sells cars and I know Bob, even though he charged twice as much, I'm going to buy it from Bob. Probably wouldn't do that necessarily. Pawn shops, one of the worst places you can go to be able to try to get money. They can charge you over 100% interest. So what happens is you give them your drill as collateral, to borrow money, and then if you can't pay it back, they get to keep the drill, and then they try to sell it. So when you go to a pawn shop, you have music instruments, tools a lot of times, jewelry, and they get your stuff for dirt cheap, and then they charge you really high interest rates. So you want to try to avoid pawn shops and check cashing outlets that can charge you like 20% on the face value of a check. So you just really don't want to deal with those companies, nor either of these. Trying to get a payday loan, which can charge you up to 780% interest, or rent-to-own centers. Don't use rent-to-own centers. If you're in dire straits and you really need that whatever, lazy boy chair, refrigerator, I don't know, and the only place you can get financing is a rent-to-own place, then I guess you can go there. But I would really advise against it. So they're typically for people that don't have the best credit. So savings plans, at credit unions, they call them share accounts. There's not a whole lot to say there. Put your money in there and get savings. So what are alternatives to like a savings account? Now, I know you don't have this chart on your page there, but just want to point out a few things. So, here you have a regular savings account with the benefits, drawbacks, low rate of return. More liquidity, money market accounts. Remember I said you can write checks on them. Less liquidity, CDs. Why? Because they typically have a maturity date on them. And then there are some U.S. savings bond, depending on what type you get, can kind of combine both of those. So the point is, when you have excess cash, there are a lot of alternatives that you can be using. Okay? So a CD, once again, certificate of deposit. Savings plan, If you take your money out early, you have to pay a withdrawal penalty. Depends on the bank what that penalty may be. It's typically like, I don't know, 3 to 6 months of interest you would have to give up. You might also want to consider creating a CD portfolio. And on the side, you might want to just, especially those going into this field, um, also referred to as like a CD ladder, meaning kind of we have different maturities, kind of different steps, if you will. That way, you kind of cover all your bases. You got some short term, so you got some liquidity, you got some long term, so you get better rates, and so on. Okay? Bankrate, all of you should be familiar with bankrate.com. It's got all kinds of great information about all the current rates, about all the different products and so on. And we'll even show you the banks and where you can get some of these CDs. So the percentage or yield is what you're making. This is really basic time value money stuff that you already should know from 3,000. You make $3 on 100 and your yield is 3%. Simple as that. So the Truth in Savings Act says that the bank has to tell you, how much, what's your annual percentage yield, okay? So expected to make over over a period of time. And there's the formula. It's on your page there. It is really, really simple math, so I'm not going to even go over it. We talked about this in Finance 3000, about the fact what we call like the real rate of return. You need to make sure that if the inflation rate is higher than your savings rate, then you're going to lose purchasing power or buying power. This is one of the biggest things that people don't realize is if inflation, which typically is between 2 and 3%, and you have a CD paying 1%, you're basically losing money. Yeah, you'll have a positive balance and your money keeps going up, but you're losing buying power. You cannot buy as much as time goes on. So that's one thing you really need to make sure your clients understand, and of course you understand. And of course there's always tax implications on interest. You have to pay taxes on the interest that you make from the bank. So taxes are not withheld from savings. So that just means that your bank, when they credit you your interest, like it's not like when you get a payroll check, your employer takes out taxes for you. The bank doesn't do that for you. So you gotta just make sure that you pay them. The after-tax savings rate of return simply means that if you're in the 24% tax bracket, for example, and your yield on your savings account is 5%, then you're really only making 3.8. So that's your after-tax rate of return, and you can see that calculation there on your page at the very bottom. Okay, so we're on the last page, liquidity and safety. So liquidity, once again, this is a very important term, and you've seen it a number of times during this chapter. So liquidity allows you to withdraw your money on short notice without a loss of principal or fees. So when we talk about liquidity, it's how easily we can convert whatever asset we have into cash, and we'd like to have it without a penalty. So the greater the penalty means kind of the less liquidity there is. So if you have a checking account, you take your money right out, that's great liquidity. Safety, the FDIC, the Federal Deposit Insurance Corporation, says that they will give you $250,000 insurance, if you will, in case something were to happen to that institution. So that's per depositor, per institution. So for those of you that have more than $250,000, you might want to split your money up amongst different institutions. So I doubt that's many of us right now. And then for credit unions, they have a different, I forget what NCUA stands for, it doesn't really matter. But basically, credit unions and banks have insurance up to like $250,000. So make sure you understand this. So let's say you have a joint account, you and your spouse, $562,000 in an account. So you've now exceeded, if we were to divide this by 2, you get 281, and that exceeds the limit by 250,000. So you would 31,000 of that would be uninsured, so you wouldn't necessarily get that back. And there'll be a question similar to this on your quiz. So types of checking accounts, I know a lot of you already have checking accounts, so I'm not going to really spend much time here. Interest earnings accounts are often called NOW accounts and usually require a minimum balance. They're also referred to, there's that word again, share or draft account, share draft account at credit unions. Okay. So just some more terminology. Overdraft. Many of you probably don't have overdraft protection. I love it. I think it's one of the greatest things. If you can get it, you should do it. That way you never have to worry about like bouncing a check or not having enough money in there, and then you got to pay pretty hefty fees if you overdraw your account. So having overdraft just kind of gives you a cushion. So you can usually get it for like say $500, and it just makes sure that if for some reason, for some oversight, you didn't realize you had as much money as you thought you did in the bank, this will help protect you. So I've used this numerous times. So when you write a check, biggest thing, just make sure you write it in your your registry, deduct amount from your balance, because there's a lag time between when your check is written, when it clears your checking account, so there might be a little bit of a difference in there. So reconciling your accounts simply means you're comparing your bank's balance with your checkbook balance. There might be differences because one, you received interest, or that the checks have not cleared yet, which is what I just mentioned kind of on that last slide, or the deposits haven't been received by your bank. Other ways to make payments other than just your regular personal check is what we call a certified check, a cashier's check, or a money order. Most banks have all of these available, and they usually will charge you somewhat of a fee to do them, depending, you have to typically have an account there. But you would use these like if you're buying something from somebody and they want to make sure the check is good. So just kind of certifying that the bank says the money. And that's it for Chapter 5.